Rohr here with an early, concise highlight on Friday, January 16th, 2015, and it's getting to be 7:30 a.m. U.S. Central Time. Coming to you a bit later because we wanted to get as close to the regular trading hours as possible while still having time to properly put together our research video, because it's all about just one thing today, and that is whether the U.S. March S&P 500 future managed to hold or violate the low end of the 1,985 to 1,978 support. Before we get into the rest of it, just a brief reminder, the U.S. is buttoned up tight on Monday. It's a full 3-day weekend here, with even the New York Stock Exchange closed on Monday. So it's a big holiday weekend decision. And we have to ask, what does all this mean to the markets? Well, the weakness of the data and the unsettled nature of the situation off the Swiss National Bank removing the cap on the Swiss franc, essentially allowing it to surge while the euro, dollar, and everything else, but especially the euro, took a beating against it, also kept the U.S. equities kind of unsettled yesterday. And in fact, interestingly enough, they're down 9 right now at about 1980, so they're right into near the low end of that 1985 to 78, and they've been down as low as 1971, so looking overnight like they might gap onto a failure this morning, but we'll just have to see what happens an hour from now. Overall, if they hold, as we'll see on the intermediate term charts, this is still just a big range. If they fail, while there are other supports, like from the 41-week, my proxy for the 200-day moving average, down into maybe 1965 and 1950, and again down at 1925. If they fail 1978, they are back in an entire lower range. It would speak to us of a real risk-off mentality that could feed on itself for a swing down to the bigger support, down at 1900 to 1875 in the next week. So this is a huge decision that's going to have implications for other asset classes. And that pretty much does it for the short-term view of the S&P, because all of the same resistances above 2005, 2013 to 16, which you'll notice we had spotted before the opening yesterday, and the market got just about there and couldn't perform. Also up into that 2005 to 2013 area becomes the important downward resistance on the channel. And above that, interim at 2025, and if it's still a big ranging market, back up to 2036 to 40 and beyond. So that pretty much does it for the short-term view of the S&P 500, except to note, even during the stabilization attempt of the last couple of days, the hourly MACD has not been able to get back above that lower runaway band. And this is another point where the burden of proof is on the bulls. Certainly unless they're below 1978, they might still be good, but at some point, to prevent it failing, you must start pushing back up at least above 2005 and ultimately 2013 to 16 to get this off of its downward signal and allow better psychology to set in.